Welcome to Jake's Take. I'm going to let Adam join me for this one. As you know, he joins me for just about every one of them, so maybe I need to adjust the name. Adam and I are going to dive into some insurance topics. Here's what I'll tell you. We don't hate insurance. We don't hate all insurance. We don't hate insurance companies. But what we find with annuities and things like that is that there's things in these policies that we like people to be aware of. There's fees. There's fees for anything you trade in the open market. We understand that. We just want you to understand that. So, Adam, why don't you dive in a little bit to what a typical fee structure looks like in an annuity, maybe a little bit on the insurance side, and just tell us like what should we be aware of when looking at these types of products?
Yeah, I think the biggest thing to be aware of is, the insurance company. It's a little bit different than investing in a fund or directly in a stock, right? Because the insurance company sits between you and the investment. So when you give money to an insurance company, whether it's for life insurance, like a whole life policy that has some investments related to it, or an annuity, the insurance company takes that money and then they don't really tell you what they go do with that money. All they say is like, hey, we're going to give you X amount of dollars subject to this index, or whatever they say, right? It can be a very complicated product or a more simple one. But on the back end, they're going to go invest that money somewhere, right? And so the question is kind of how much of what they invest in gets passed back on to you. And now, insurance companies, it's not just an investment product, right? And so a classic example, like term life insurance, is a really good idea for a lot of people. And you can't go get term life insurance in the stock market, right? Like that's the death benefit and the security that could bring your loved ones. That's an important thing that you can't get by going and buying a stock of Apple. But a lot of times they kind of rope in other investment things alongside that. And so I thought it'd be interesting, given that structure, you're not necessarily always going to know all of the fees, right? A lot of them are just baked in, right? So if I say, hey, I've got this great deal for you, it's called Adam whole annuity, whatever, right? And I say I'm going to give you 70% of the S&P 500's return, right? Well, you'd probably look at me and say, well, I can just go invest in the S&P 500, so why would I take 70% of it? The truth of these insurance contracts is they function somewhat like that, but they're much more complicated, so it's not as easy to say, oh, you're only giving me 70% of the return. They'll say things like, we'll give you all of the S&P 500 return, but capped at this amount with a floor here, and there's going to be this minimum, but this fee here. And behind the scenes, what they're doing is they're going out to the market and they're buying derivatives and things like that on the back end to create that same return for themselves and then pass a little bit less of it on to you. And so, anyways, what's interesting, we took a look at the financial statements of AIG, a big insurance company. If you look at their life insurance division, the profits they make, all the money they take in from customers, the returns they make on the investments from the customer's money, less the money that makes it back to the customer, and also their expenses like paying their staff commissions and things like that. They end up with about 4% profit on life insurance, which is a good little business, but it's not crazy high, right? Like that's not a crazy profit margin. You look on the annuity side, it's more like 30%, and that doesn't include again the commission that the agent that's selling you that annuity is getting. And again, this is on average across all annuities, but 30% is a large amount to take as profits. And that's not to say they're never a good idea, but when somebody's making a 30% margin in a way that's not disclosed, it's just an extra level of caution you need to bring to evaluating that product or that investment.
So this company made 30% on annuities, 4% on life insurance. You think within the life insurance that includes probably all life insurance, like term, whole, and all that? Why do you think it's such a difference between life insurance and annuities?
It's a good question. That's a question I have myself. I need to do more digging to know if whole is included in that life insurance or not, or if maybe they split it out and they kind of have, hey, here's the life insurance part of the whole life product and here's the investment part of it. But I would say, life insurance. And we even see this on the annuity side, is maybe the better way to answer your question. So there's things called fixed annuities, which are usually the simpler annuities. It's, hey, you're going to pay, or you're going to invest this amount, and then we're going to pay this fixed amount back to you every year until you pass. And then there's more complicated ones like variable annuities, where it's like, okay, you're going to pay this amount, but then we're going to return to you, something that's linked to an index with a cap and a floor, and we actually see a difference in those two products, and they make not quite twice as much, but close to twice as much on the variable annuities as the fixed annuities. So I think it's like any other product you buy. The more kind of bells and whistles and customization, the harder it is to comparison shop that product versus another product. Probably the more margin a company's going to be able to get away with charging. And so, like if you go out right now and you try to buy a used Honda Civic with 30,000 miles, there's probably thousands of those for sale in the U.S. right now. You're going to get a pretty tight range. But if you're trying to go find like a 75 Camaro that's been in less than one wreck that is a certain color, it's going to be really hard for you to know what to pay. You're probably going to have to get some like special book of all these classic cars or whatever. And so anyways, the more complex the products, the more kind of hidden and baked in the fees are typically, probably the more money somebody's going to be able to make. And I would say that's a general thing, not for insurance, but we're the only fiduciary advisors. I feel strongly that whenever you're talking about an investment product or investment advisor relationship, any types of tools, like one of the most important things to understand first is who's getting compensated, how are they getting compensated, how much is the compensation, and how much transparency is there around it. And that's not to say you can never engage in a relationship or purchase a product where you don't fully understand how they're being compensated. Like if I go buy a car, I'm not going to ask for the pay stubs of the guy selling it to me. But it should definitely heighten your level of caution when you're unsure about like what the arrangement is and how much you're really paying for something.
Yep. That's a good place to end is with your car analogy, is that some people's plan requires that unique 75 Camaro. And if your plan requires that, then maybe you need insurance to solve it, maybe. But just be aware of what's inside there, be aware of why you're doing it, be aware of the cost associated with it. Absolutely.